Hello and welcome to the IFRS 17 training series. In this video, we will cover the Premium Allocation Approach, or PAA. The Premium Allocation Approach is a measurement model to calculate the liability for remaining coverage, or LRC, and it's a simplified approach compared to the GMA, or General Measurement Approach. It's applicable to many group and property and casualty contracts. To be eligible for the PAA, there are some requirements. A group of insurance contracts is eligible to use the PAA if the coverage period of each contract in the group is 1 year or less, or the LRC, liability for remaining coverage, calculated under the PAA is not materially different than the LRC calculated under the GMA. So if you have a contract that is 12 months or less, it will automatically qualify for the PAA. If their contracts are longer than 12 months, then you have to do an assessment. You need to measure the LRC under the PAA and under the GMA. And if they are not materially different, then you can apply the PAA to that group of contracts. Now, an entity has a choice to adopt the PAA if eligible. They are not required to do so, though. But however, most entities would likely choose to use the PAA as it is a much simpler way to value the LRC under IFRS 17. So what does the LRC and LIC look like under the GMA and PAA? Under the GMA, we have our building blocks. We have our future cash flows, which are also known as the best estimate cash flows. We have our risk adjustment and we have our discounting. So taken together, our best estimate liability and our risk adjustment are our fulfillment cash flows. Then we also have our contractual service margin, or our unearned profits. Well, under the PAA, it's a simplified version of the LRC. And under the PAA, the LRC is equal to our unearned premium. The key difference between IFRS 4 and 17 is the definition of those premiums. Under IFRS 4, it was premiums written, and under IFRS 17, it's premiums received and earned, or unearned. Under the LIC, liability for incurred claims, the two approaches are the same. So it's the same under the GMA and PAA. It's our present value of our future cash flows and our risk adjustment with no CSM. So the liability for remaining coverage is very similar to the IFRS 4 unearned premium approach. The LRC on initial recognition is equal to any premiums received at initial recognition minus any acquisition cash flows at initial recognition if there are any, plus or minus any derecognition of any DAC asset or DAC liability, where DAC is deferred acquisition costs. For insurance acquisition costs, those cash flows under the GMA are deferred and included in the liability cash flows. Under the PAA, you can also use this approach by default. However, an entity can also elect to expense acquisition cash flows as incurred if your coverage period is 1 year or less. And this would simplify your accounting procedures because you no longer have to calculate a DAC asset for those insurance acquisition cash flows. In terms of discounting, the LRC under the PAA is not always adjusted for discounting. Discounting is not required when coverage is provided less than 1 year from when premium is received, but discounting is required when coverage is provided more than 1 year from when premium is received and the contracts have a significant financing component, as per IFRS 15 revenue recognition. So if applicable, PAA discounting methodology is the same as GMA, and we have a separate video on discounting that you can check out to learn more. Next, we'll talk about the risk adjustment, and the risk adjustment is not required for the LRC under the PAA unless the group of contracts is onerous. If the group of contracts is onerous, then the GMA approach would apply, and you'd have to calculate a risk adjustment. The risk adjustment is required, though, for the LIC under any PAA contracts. Next, we'll talk about revenue recognition. Under the PAA, your insurance revenue is equal to your expected premium receipts allocated to the period, excluding any investment components. So it's equal to your premium received in the period and earned. The allocation is either uniform or straight line passage of time, or it would follow the pattern of your insurance service expense or your claim patterns if it's significantly different than uniform. So for example, seasonal claims such as hurricane claims or snowmobile claims that typically snowmobiles are only used in the winter, so you'd only see snowmobile claims in the winter. Finally, we'll talk about investment components, and we have a separate video that dives into investment components, but as a reminder, an investment component is any amount that is eligible to be paid whether an insured event occurs or not. So for example, for longer term contracts, cash surrender values and endowments are examples of investment components. Now, investment component experience under the PAA has to be reported separately, just as with the GMA. Finally, we'll talk about onerous contracts. So when a group of contracts becomes onerous, a loss is recognized immediately. And we need a framework required to identify when a group of PAA contracts becomes onerous. So some potential things to examine would be the loss ratio experience. If, for example, if expected costs increase, that would increase your loss ratio and may drive the group of contracts to be in an unprofitable position. Or if there are regulatory or economic changes, those could adversely impact the claims or expenses of the group of policies, and that could push the group into onerous territory. So that concludes our video on the premium allocation approach. Thank you for watching.